Yeah, make sure someone hits the record button.
Yeah, we got it. Thank you, Kim. All right. Well, good afternoon and welcome to our final bull session of April 2025. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and a volunteer for the Better Investing Mid-Michigan chapter, doing all I can to support the magical mathematician of Mid-Michigan, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark, and thank you so much for all the support you give to the Mid-Michigan chapter of Better Investing. We really, really appreciate it.
And speaking of support and getting poked and nudged into exploring neat areas, we're joined by Florida's Kim Butcher. Good afternoon,
Hello.
Kim.
Hello, everyone. Nice and sunny, and I'll probably be at the pool as soon as this is over.
I kind of rival that. More on that in a second. And we also have with us today in the back room our wonderful colleague from Matt Spielman. He's giving a presentation at the upcoming National Convention for Better Investing. Welcome, Matt.
Yeah, recently promoted. Don't forget that.
And recently promoted with a huge salary. I guess maybe you're buying drinks the next time.
Sure. We all owe each other drinks, I'm sure. We already pay back with ridicule for the bad moves we make.
All right, so that is the view from my office today. That's my view right now. Mine is Cannonball Man. He's not here. He's a figment, but we're going to talk about Cannonball Man here in a few minutes, and we're going to continue our discussion on cash flows a little bit and talking a little bit about being humbled by an investing legend aimed directly at the heart of Illinois. So that's a tease for you. But yeah, we'll have some fun here. Ken, any thoughts on your mind? I mean, we've got 71 degrees here, headed for 80. Is it okay back there?
It's warmer in mid-Michigan than it is in Phoenix, Arizona right now. We're at 82 according to the thermometer on my deck. So and we're supposed to be going up to 84 or 85 today. Very unusual for this time of year for us.
And Ken, that orb above Cannonball Man there, that is the sun. You know, and you don't get a whole lot. We don't get a whole lot of that back in Michigan, but
it's been out for 2 days now, so that's about all we're going to get until maybe the middle of May again. But I'm going to enjoy it while it's here. I
knew we came down here at the wrong time. Good stuff. All right, stuff that's going on this week. Again, we're going to be with some of our colleagues from the St. Louis chapter of Better Investing this evening for the roundtable. Many of the images basically reflect that. We are going to talk a little bit about artificial intelligence, but I just returned to some of our favorite recent quotes, including Charlie's quote about the business, understanding the business, and of course, Abraham Lincoln's quotation that urges us to consume an adult beverage every once in a while. And that is also in honor of St. Louis and their production capacity down there. All right, moving on. This is our weekly reminder that Portillo's is not a sponsor of the session, although they should be. And yes, Kim, I'm starting to get mail from the haters and notes. Portillo's for breakfast, and they're ridiculing and hating, and haters gonna hate. What do you think?
I think those breakfast sandwiches look outstanding. I mean, I'm sorry. I'm not driving to Orlando to just check out a breakfast sandwich, but when I get there, I'm sure I'm trying it out and getting a few pictures for you.
Well, we do have a Portillo's in Scottsdale, so I may wander over there at some point in the next couple of days.
Well, I'm looking at these graphics here, Mark. Could you go back one slide, please?
Really?
Please.
Okay.
And I'm just going to highlight the very last 8 or 10 words of Benjamin Graham from The Intelligent Investor when he says, give speculation the deceptive guise of investment. And that's what I think of those pictures on the next slide. So I just don't have a lot of good feelings about looking at pictures like that and trying to draw advice from them. But I know that there's a heck of a lot of people that live and die by technical analysis. So there it is.
I will tell you that on the way out here, I actually read Arnold Bernard's book from 1959 again, and he mentions, get the fundamentals right, understand the same type of stuff that we do all the time, but he does endorse point and figure charts in the text, so we'll be talking about that.
That's the
Yay,
one.
'cause I like
That's the one on the left, right, Mark?
That's the one on the left. You have less heartburn with that one, right?
I have a lot less heartburn with that one than with Ishimura here, yeah, or
All right.
Ishimoto, yeah.
With that in mind and reinforcing Ken's words, no investment recommendation is intended. What we are attempting to do here is share the stuff that we have witnessed and experienced with the modern investment club movement, from the discovery of opportunities to the analysis and the construction of portfolios, which we take care of so that they will take care of us. So that's what we do here. The modern investment club movement is going on the better part of 8 decades. And what's really cool about it is it helps you find better companies and recognize when they're on sale. Having said all that, you do have to do your own homework about any investment decision, and we will also try to remember to disclose if we own anything that we're talking about in our personal portfolios, but it is all up to you. If you'd like copies of these slides, or if you have follow-up questions or topics, feel free to send to either of the 2 email addresses on the screen there, and we'll see what we can do with them. You lead us to some wonderful places, and I think it helps everybody when we share that type of thing. Thoughts, Ken?
I like what you have to say. Let's keep moving.
All right, here's the market. What do we see here?
Well, I asked Mark the question before we started about the disparity between the value line appreciation number and the MyPAR number. It's getting wide again. It's a value line at 14 plus and MyPAR at 11 minus. So 3-point spread in a number that small is a pretty big spread. And Mark gave me an excellent answer. He said, remember that value line is backward looking. It's taking care of what happened before, and it doesn't include the last week or 10 days of data. And when the markets are moving the way they're moving, and when MyPAR is moving on a daily basis, there can be this spread as the data gets separated a little bit from reality. So I'm very satisfied with Mark's answer, and I don't think anything's breaking down. I just think that we have time entering the picture, and anytime the starting point or the ending point is changed on a race, then the race changes, and that's what's happening right now, I think.
As an example, the market hasn't been exactly red hot in the last day or so, but in one day, this light green bar has almost caught up with the green bar to the left of it. I mean, it's closed that gap in one day. So, I mean, it's a very turbulent market. And here is a look at that turbulent market over the last month, looking at the value line arithmetic index day by day. And the point we're making here is it's basically back where it began April. And Ken, I've told this story before. I'll tell it again. I can remember vividly an investment club meeting in Chicago where my entire thing was, if you didn't know anything that happened between the 2 club meetings, you thought we were at the same place with no fanfare or anything else. Yet the stock market had gone down 15% and recuperated. So between meetings, if you didn't look at anything else, the numbers were the same meeting to meeting in those monthly meetings. So I think it's just a reminder that paying attention to the day to day can be quite a distraction.
I will temper that remark just a touch, Mark, by saying that there has been a larger disruption in some of the most favorite stocks that we entered the month with.
Mm-hmm.
So if your portfolio was really heavy into what have become known as the Magnificent Seven, you might not be back to where you were at the beginning of April. But at the same time, if you had a well-diversified portfolio, then chances are you're very close from one date to this date right now in where your portfolio is.
Yeah, the Wilshire 5000 is 3 to 4% above where it was at the beginning of April. And also, when I said that I was fully invested and that moment with the relative strength index under 30, I'm not kidding. I had to scrape together money to pay taxes this year, and it was a good experience. Don't cry or sweat for me. I mean, it was a good thing. Here's the QQQs, which kind of tiptoes at what Ken just had to say. Depending on which one of them you have or group of them that you have, your results could vary a little bit. But this one irritates me a little bit, so I'm gonna share. I mean, I'm watching to see when CBS, NBC, or ABC will mention that apparently the April apocalypse is no more. They haven't yet. Not a single second of airtime dedicated to the reality of, I could have missed a day, but the reality that stock prices are basically where they were a month ago.
And
I
I
don't
bet you
often
won't, because the next thing they say is sell in May and go away.
Yep.
They'll just keep the negative going.
I don't often talk about specific trades that I make on specific dates, but I use manifest investing quite a bit, as many of you know, and it allows me to set alerts for various things. And I have an alert on the triple Q. And around Liberation Day, that's the day that Mr. Trump announced all of the possible tariffs he was going to deal with, somewhere in the first week in April. Maybe around April 3rd, 4th, 5th, somewhere in that general area. I got an alert that the RSI, and I have just disparaged technical analysis 3 slides ago. So now I'll say that I got an alert that the RSI had fallen beneath 30. And what I did was, in all of my portfolios, every one of them, I took any cash that I had and put it into triple Qs. Thinking that it was a great place to hide for a period of 20, 30, 40, 50 days. And it's proved to be one of my better moves in portfolio management that I've made in the last couple of years. So I'm very pleased with being able to do that.
Well, you know what makes me sad, Ken?
What's that?
Well, I know a lot of things, so just tell me one, Mark.
I actually had thoughts of reviving my tequila trifecta back around April 7th. And I should have. All right. We'll keep going. Okay, let's check in on the groundhogs, because this is good news. We have a few more groundhog millionaires. I've read the list 5 times and my name's not in there, so whatever. You can see that the groundhogs have actually gained about 8% in the last month. Well, the last week. So 40% are now beating the market. You can see the market levels represented there. The animals, by the way, are javelinas. If you're not familiar with those are Arizona creatures, and right outside where I'm sitting. But what do you see here, Ken? I see more groundhog millionaires right now. This work in progress.
I see a lot of them. We're still at 9 clubs, however. We can't seem to get past that 9 clubs in the top 40. We probably have a slew of them between 41 and 60, but 9 of them, with the lowest of the 9 being at spot 28. That's the Penn State number 9. I'm not familiar with who's in that particular club, but they are doing pretty well.
That's Sean Moose and his classmates. That's Sean.
Is that Sean? Okay.
Yeah,
I am duty bound by a vow that I made in the Wolves Investment Club to mention Don Sheets, who's a wolf, and my grandson Ethan Dunman, who's a wolf. Ethan's in 8th place. Don has moved back into the top 20, so I have to mention his name again. And I give a shout out to Bob Hool, who has stayed in the top 40 and has been in as volatile a portfolio as I have put into the groundhog contest. So just moving all over the board, up and down and every which way.
All right, so Ken, there are people asking, where's Ken Kavula on the list? Where's Mark Robertson on the list? And this is a good moment to point out that it's not necessarily the results of a few months that matter so much. Let's talk about long term. And you see these numbers here: 18 years. You qualify for inclusion on this list if you participate for 3 years or more. You can see that Jim Gallagher out of Florida took over #1 this year. But here's where you find Mark and Ken's name, and we don't get too crazy about the results of any one particular year. By the way, Kim, I think you're in 28th, and have done pretty well here lately, so possibly moving up the list. Good stuff.
I think it's very interesting, audience. I'm talking directly to you now. I think it's very interesting that Mark can find statistics to show that we're not doing as badly as we really are in the contest right now, and he can balance that with statistics that show we're doing okay. All right.
It's called context.
Context. Okay.
Well, you hear us talk about, Ken just mentioned the investment clubs towards the top. The cool kids have never won, but they're always up there in the top 5 in their 4 or 5 years of participation qualifying. But notice those clubs, Space Coast, Broad Assets, Power City, those are multi-time champions along with Orange County. And those clubs are frequently up on the leaderboard. That's why we talk about them so much. All right, so enough. We're dare I say, Ken, that unless we get our act together, we might drift down this list a little bit.
I think next time we put this up here, Mark, we should put a column in that shows how many years of data the ranking represents, too.
What's this? It's right here.
Where did I miss it?
Where
is
right there.
Oh, it's way over there. Okay,
Nice.
well, in that case, I'm very happy to see those 8 teams. and I should say to Bonnie and John, the 17 and the 14 is nothing to sneeze at, folks. We have another 17 up there in Bower City. So
It's Susan Michelik and her band of desperados. Good stuff. All right. As far as what's been going on here lately, here's just a quick check-in on all the companies that are among our favorites. They're the most widely followed companies by subscribers. Buttonwood is still obviously a work in progress, and we're pretty confident that we eventually will make a really good decision. I also wanted to feature this First Trust NASDAQ semiconductor, FTXL here, because it's obviously done pretty well for a couple of months. So let's talk about that one. This is the Nick DiVirgilio disclosure moment. Sometime Ken, you're often telling me to listen to myself and kind of follow the things that I say. I got cold feet and I needed some money for capital gains. I sold that after it had gone up to about 70. And you can see that it's actually done pretty good here over the last month. The premise behind this entire thing was that semiconductors were not going to be materially or significantly affected by tariffs. And I still believe that. There will be some, but the key word is materially. And I was gonna retire and buy an island on this one, and instead I sold it. And Ken says it just proves that I stink as a trader.
I'm not going to make any comments, Mark. Let's go on to the next slide, okay?
but Nick, there you go. It's holding up pretty well across the board. There are some alternatives, but it's a teaspoon of humility.
We should stress also these are very, very short-term numbers.
Absolutely.
They come from April 3rd. April 3rd. So don't put a lot of money behind any of these numbers. They're very short-term right now.
But see, if I had invested enough in this, I could have bought this Adobe Castle, with the proceeds. But no, I got cold feet. Oh well. All right, here's our quick look at Buttonwood, just reinforcing this notion of we basically are back where we started the month, and even from a 5-year perspective, even though we have lagged the market by 3 or 4%, as we said, the market's gone up 3 or 4% in the last month. So that shows in our results. And Ken wanted to talk a little bit about the actual specifics. We'll take care of this one in a couple of weeks, but here's the current.
Well, Mark, I'm talking from the point of view that I'm pretty pleased with the par values that are attached to all of these. Even the lowest par with Visa as a good, solid, huge company which kind of anchors the portfolio. 8.5 is nothing to sneeze at from a company this size, but all the rest of the par values are double digits. So we're doing our job with par, and we're moving towards a par value that is coming close to my par plus 5, which is, you know, the sweet spot. So that 14.5 is a great value. If it were in any of my portfolios, I'd be very pleased with it. I'm struggling to keep my portfolios at 12.5, 13, 13.5 right now in this market, but 14.4 is really good. What we have not been able to do is maintain that growth column, and that sales growth over a long period of time is going to contribute directly to the par number. And that sales growth better be up around 13, 13.5, 14 if we're going to continue with a par as high as this one is. So what I'm setting for myself and for my thought process is to look at Lululemon, United Rentals, and Gentex. Now, we've already looked at Gentex, and we've said we don't especially like the growth rate in the company, but as long as the par value stays where it is, we're going to give the company a pass. I think the same argument can be made in not so strident a tone for United Rental and Lulu. We're looking at really substandard growth for the kind of portfolio we're trying to put together, but we have double-digit pars. And I think in this market, double-digit pars are fairly difficult to get to and then to maintain. So I want to put all three of these stocks, I don't know what we want to call it, Mark. It's not exactly a timeout, but I think what it is we're going to put them on a list where we're going to give them extra special attention. And if and when the par values begin to slide, I think that will be the first, you and I will agree that if they slide down to average or below average, and they're slightly below average right now for the first two, but if they slide very much further, then I think these are three candidates for taking that cash and reinvesting it into something that has a higher sales growth number and a higher associated par to go with it.
Yeah, I would agree 100%. I mean, our attitude on Gentex, we love the company, we respect it, but under the current situation, if the par approaches 10, or if the relative strength index approaches 80, we would probably jettison it. And United Rentals has sagged back a bit, probably some recessionary concerns there. They could be unjustified. And the other one is Lululemon has had, the analysts have gone a little bit pessimistic on Lulu. And that's where some of that weakness comes from. So we want to watch companies like Lulu carefully. There was some talk of tariff impact on them, but I think they've pretty much solved that with some of their sourcing. But yeah, we'll just keep a look at these and keep continuing to build. It's a solid portfolio. It just might need a little TLC.
And at the moment, we can give good reasons for all three of these companies lagging the market a little bit. Gentex is in a very challenging industry, the automotive industry. United Rentals rents huge pieces of equipment, and they rent a lot of it to agriculture, a lot of it to construction. And those are two places that if the economy slows, then the rental business is going to slow right along with it. And Lululemon gets most of its supply from Southeast Asia, not necessarily from China, but from Southeast Asia. And we have that cloud of tariff hanging over anything to do with imports from Southeast Asia right now. So we can give good reasons for why it's happening. We just don't want to end up making excuses for these companies past the point where we could maybe replace them with something that doesn't have those kind of questions behind it.
And I would translate that as we want to avoid another fossil like our lives depend on it.
Absolutely. Yeah, absolutely.
All right, switching gears to talk about Charlie's emphasis of really understanding businesses. And what we have done is stack up some historical data for over 200 companies and come to the conclusion that the projected cash flow growth, or the cash flow trend, however you want to think about it, is probably a pretty decent thing that we want to be aware of. And, Value Line uses it exclusively, but I really like this notion of it resembling. So if Ken's favorite word is reasonable, I'm going to tack on resemble. Are you okay with that, sir?
I'm more than okay. I think resembles a wonderful English language word that's easily understood by most people, that says they're not identical. And that's the key, I think, to understanding a lot of the numbers that we deal with in analysis. When you look at a 10 and an 11 in an analysis based on judgment, 10 and 11 are really the same number, just like 8.5 or 8.8 and 7.5 in an analysis are probably the same value.
Mm-hmm. From a resembling standpoint, for sure. All right, so let's go ahead and talk this one. I have about half the companies in the standard edition in this calculation right now. And yes, welcome back to our Cannonball Man. That is not Ken or me, but Cannonball Man returns because remember we talked about this when COVID hit and when the economic disruption. We talked about it as perhaps resembling that gentleman jumping into your backyard swimming pool and causing a tidal wave that may have even pushed a bunch of water out of the tub or the swimming pool, and that there probably were going to be secondary waves. And I think you could make a case for, the cannonball hitting in 2022, 2021, and then a little bit of a wave coming out of it, and maybe tempering back to that long-term trend. Again, this is the average cash flow for a whole bunch of companies. And the other thing that I would like to point out, and then I'd like to hear your thoughts on it. I mean, the wave image there is just to remind that this is not irrational. In fact, there's people out there that do wave theory when it comes to investing. But I also wanted to point out that there's definitely some economic pressure here, and that's well before the impact of tariffs. In fact, 2024, most of the companies have their final results in the books for 2024. That actually ducks back below that long-term trend line. And so the economy was already weaker than many people were talking about in 23 and 24. And we are collectively hopeful that these numbers are good. Your thoughts,
Well,
Ken?
I'm just reminding our audience that green line is not a sales line in this case. This is a cash flow line that you're looking at, and it's a line that's a little bit on the new side for us that we've been exploring. And Mark's been putting together a lot of data from the value line, major value line, the primary value line, and we'll have all the companies in there eventually, and we'll get some data that we never had before. That graphic just, my most despised class, Mark, was an advanced physics class, about third semester physics class, where we did a lot of work with sound and light, and we used ripple tanks and everything else. And I just hated the class, and I had to draw all kinds of pictures. And this reminds me of the kind of pictures I had to draw. So we should just indicate that's a graphic. It's not really telling us anything about stocks, but it is a graphic that makes me uneasy only because of my thoughts back to third semester physics, which I abhorred, I hated. So with that being said, I echo your thoughts about those three dots that you've circled, that I hope that our future projections are somewhere close to where these projections are, because if so, that puts us back on the same general trend that we were back in 2016, 17, 18, which was a pretty good period of time in history to be an investor.
Yeah, you're looking at a 9% growth rate there for cash flow aggregate. All right,
Yep.
so here is reinforcement of this resemble concept. We believe, and we're basically tentatively believing, and we're just exploring mightily the notion that the projected annual return, that's no different than Section 5 of a stock selection guide, should resemble or can resemble the projected return on value, and ultimately that third leg being the projected cash flow growth. And you see the three characteristics for three companies submitted by Sandy Castor in our forum. That's First Solar, ELF, the cosmetics and beauty company, and PAYO is actually what I believe to be a young version of Paycom or Paychex. And here are the projected cash flow growth numbers for those three companies. Here are the projected returns. Again, that would be very similar to Section 5. And here are the proofs. And my argument here, Ken, is I think we should start with the company with the highest core rank, because that is going to be the best one for a beginner or a novice to explore. What do you see here as you look through this?
Well, I'm not especially upset with First Solar either to take a look at, Mark. I think they both say some good things. They both indicate that we still should be doing a little bit of questioning, but par and prove kind of go hand in hand on all three of these companies.
Mm-hmm.
The middle one and the third one there, and the cash flow growth for First Solar at 20 and the par at 27, I guess that's spaced a little bit wider than I would appreciate, but at the same time, they are at least walking down the same sidewalk maybe, and ELF is doing the same thing at 10 versus 16 versus 12. They're all in the same general area. The one that is outside the area, and we might draw a rule from, is this PAYO. And I think that you're going to show what our rule might be on the next couple of slides. But
We'll get there.
Basically, we need data to do any of these kind of analysis. And if you don't have data, you can't really draw conclusions from no data.
So again, in terms of thinking, especially if you're a relative newcomer to investing or a novice, what you're basically seeing here are opinions from some different sources. The value line median total return forecast for these companies is they're very strong for First Solar and ELF. And then what you see here is just a collection of opinions that basically say that you're looking at 6 opinions that these companies are perhaps on sale. In fact, First Solar and ELF really on sale, perhaps too good to be true, would be how I would look at that. So let's go ahead and get started. Again, if you're a relative beginner or newcomer, anytime you're dealing with up straight and parallel companies, relatively up straight and parallel, you're going to have an easier time than the one that says 32 there. All right, so here's a look at the first company, ELF Beauty. I think this one is pretty comparable to help me. What's your favorite company up there in mid-Michigan?
Oh, you mean
Ulta?
Ulta Beauty. Yeah, I think it would make for a good comparison side by side. But what you see here is a company that got a fairly decent quality perspective here. They've been doing a lot of things right in recent years. You see that the company is trading at near a multi-year high in the return forecast. I think this picture on the right with respect to the sales trend, remember we talked about last week, if you're going to trend something, you probably want to avoid starting your trend, anywhere in this time frame when the company were having serious retail challenges. So we do that. But I think this qualifies as up straight and parallel enough for further discussion. Your thoughts?
Well, I think that if I were sitting in a club meeting right now, that most of the members in the clubs that I belong to might have the comment that a lot of the growth that we've projected for ELF, both in sales and well, not so much in earnings because there's no earnings graph here, but in sales and the blue line down there at the bottom of the price chart, which is earnings. I think that we might be saying that the projections look like they've flattened quite a bit. And then the final projection, the one out 5 years from now, seems to be maybe a little bit of wishful thinking. So
Could be.
I'd kind of I would worry about actually moving forward on the analysis of this company, only because the real data is showing me something pretty different than the projected data from, say, 2024 onward, you know.
Mm-hmm. So here we're talking about a company growing at about 14%. So yeah, it's flattened, but it's flattened at 14%. You know, an EPS growth forecast in low double digits, a PE in the low 20s gives us this number, which is what we want to basically reconcile, that projected return versus the other methods. So here is a look.
I
Go
want
ahead,
to do
Ken.
a gentle challenge on something you just said, Mark, and I'm wondering if that 24, 25, 26 growth rate for sales would be at 14% if we eliminated the 2029 dot. That's the point that I'm making.
Yeah, it would change. It would change it a little bit for sure. Yeah,
Yeah, yeah.
especially
And
with that 26 number being lower. You know, this is
yes. Uh-huh.
so. Yeah,
So it's just it's in the eye of what you think you can find, and I happen to have a very firm belief that there's enough companies out there that I can find that don't have some of these questions attached to them,
mm-hmm.
and therefore I don't have to spend a lot of time looking at a company like this if I don't choose to.
All right, if you're going to go that deep, I would also urge the audience to notice this right here. On the lower right, you can see that their 3 to 5 year forecast for Value Line is actually taking a step backwards. Nicholson called it backsliding. So, you know, the expectations have been moderated for this company. So that's something I notice as I'm, you know, considering a company like this.
And that last price bar is no higher than the price bars from 23, 4, or 5, really, especially from 4, 4 and 5.
Mm-hmm.
Yeah.
Of course, if you bought it right here. All right. So here we're going to basically do a gut check using the prove, which is projected return on value. The calculation is kind of mapped out here. So what we basically do is borrow the 5-year sales forecast from right here. Same math is involved. Okay, but in this case, we apply the projected operating margin at 23%. That's the analyst consensus, and I think I can embrace that based on this picture up here, Ken. That's okay.
Yes, I agree. I think that number is fairly is fair. Yeah.
And everything else is basically a plug and chug type number, and what you end up with is a 12.4, which is fairly consistent with that 16. It's off by a little bit, but it's not an order of magnitude different.
And if it were me doing the SSG, I might go back to the PAR calculation then and ask myself, what was I using for the PE? And I might adjust that PE down just a touch. I might adjust it down to 21 or even 20 and a half, you know, just to bring them a little bit closer. But I also think that a case could be made to leave it right where it is.
Yeah, and I anticipated Ken's question. So that's why this PE chart is here. Maybe Value Line's being optimistic. Even if you set that aside, these numbers here are all fairly supportive of a number somewhere in the neighborhood of 20, for sure.
Yep. Understood. Absolutely. Uh-huh.
So we've got those two side by side, and then we go ahead and we add the cash flow growth as kind of a check. You could almost think of the projected cash flow growth as a nudge of a more, I hate to use the word terminal. I mean, S&P, CFRA uses, you know, terminal growth rates and values and that type of stuff, but, you know, perhaps maturity might be the way to think of it. But that also comes in at about 9.8%. That's even with a little bit of tempering. So not in too bad a shape. And again, keep in mind, we are focused on post-pandemic for that calculation of the cash flow. So.
And we might be moving towards the conclusion, Mark, that those two numbers, the prove and the whatever we're going to end up calling this projected cash flow number, those two numbers give us a little bit more ammunition to maybe
Mhm.
ratchet down that PE on the par right there, that 21.7 a little bit. So it's a work in progress, but it certainly has some promise to it, and it certainly is leading us in a direction that's going to be quite helpful to investors that use the analysis tools that we use on a regular basis. It's going to help with that age-old question is, what do I finally set as a PE value, an average
Mhm.
PE value,
So here you have a situation. We've described the company. They seem to be doing many good things. Very low interest rate on their mortgage, if you want to think of it that way. So a good, probably pretty strong financial strength. Notice that they are in that below 20% range. They're very close to their low price. Value line is basically calling for a 20 to 32 return forecast. So that's attractive for a company like this. And then you've got Morningstar and the analyst consensus suggesting the analyst consensus, they are probably hyperventilating a little bit. Time will tell. But yeah, this looks interesting. The only thing that bothers me so far is the two things you pointed out, Ken, about the characteristics back here, numbers being maybe a little bit high and a little bit of backsliding.
Yeah, the whole concept that we're talking about uses a lot of different guesses, and we don't like to use the word guess, so we say forecast, but they're guesses. And our experience with that last guess at the bottom of the first column there, that analyst's number, our experience with that has always, in the last 4 or 5 years now, shown us that that's always a little bit pie in the sky kind of a number, and we don't tend to give that as much weight as we give a lot of other values that we take a look at. We tend to believe that Morningstar and Value Line are being a little bit more careful in their judgments going forward, and that when you get a group of analysts together, sometimes they feed on each other and they come up with numbers that are sometimes extremely aggressive.
Now, if I'm in a club meeting with Ken and I really want to buy the stock that I'm nominating, I would find ways to beat back all of that skepticism. And anyhow, all right. So let's go on.
You might mention they have just started a partnership with Target, for example, small customers like Target. I have to disclose, I did buy them. I've been watching them since 2020 or 2021, early to mid pandemic. They've been on my watch list, and kind of like, I don't have any personal expertise in that area. I watched them, and then they got really cheap, and so that's where I put some of my cheap money to work.
You haven't turned one of the rooms in your house into a makeup room for your television programs yet, Matt?
from my TikTok channel, yeah.
Okay.
He's an influencer. Good stuff. All right. Well, there you go. I mean, Matt has been following the company, and he just brought another element that strategically, that sounds like a pretty good move. If they manage it well. So another piece of information which bends the decision a bit. All right. Here's a look at First Solar. Again, improving quality, relatively high multi-year return forecast. Interesting sales graph down the middle. You can start trying to put a trend line through any of that. I'll come back to that. I think the earnings one is even more interesting, Ken. It's the kind of thing which would attract the attention of Hugh McManus, maybe. But yeah, interesting. This is
I would like to focus on that quality for just a moment, Mark, because this is the second best quality kind of graph that you could see. One of these that are just, generally in the last 3 or 4 or 5 years moving up to a very high level. The only thing better would be a nice horizontal line up above 95 somewhere. But this is an excellent kind of quality line for us to see. When that quality is degrading, moving in the opposite direction, that's a huge red flag as far as I'm concerned. A huge flag. And this one and ELF, neither one of them have that red flag.
Now, I'm going to say something slightly controversial. Some of you will hate me, but I do question the use of performance-enhancing drugs here. Um, Basically, I think you're looking at a situation where there were fewer incentives, and I'm talking about government incentives back in this time frame, and those incentives reversed and did this in the next few years. And my question would be, could they go back to this? And I think that that is a finite possibility. So that could be something to think about with this company, but we are looking at decent growth rates, very normal PEs, and a elevated projected annual return. The threat to that, from my perspective, would be a change in government attitude. Is that sugarcoated enough?
Well, and it's a fair criticism, Mark. Whenever a company depends on government subsidies for part of the money that it's making, part of its revenues, we have to question how long those subsidies stay in place. And for First Solar, maybe they don't stay in place quite as long as the anticipation is right now. I mean, this dot is out 5 years, and I'm not certain anybody can predict politics out 5 years. Heck, in today's world, I won't even go there. I'll stop. Okay.
Yeah, stop at 5 weeks. 5 weeks is a challenge. All right, let's look at the prove. The prove actually comes in and reconciles pretty nicely. Again, keep in mind that we are just taking the normal 5-year sales forecast that you do with any stock study. And in this case, the projected operating margin, that's the big question here. I have no idea where that's going. I know that it's going up, or it has been going up. There's no guarantee that it'll continue to go up. But if you assume a projected operating margin in the 50 range, right up in this range, that's not impossible. But if you assume that, you basically match up pretty close. I would also argue that the relatively low PEs are a sign that there are a few people out there that have similar skepticism and concerns. Would be the way I would read that.
That's the same kind of thing that goes on for healthcare companies, Mark, for United
Sure.
Health or Humana or anything like that. They depend on Medicare, and what's Medicare going to be doing 3 or 4 years from now? Same kind of thing that's going on.
Mm-hmm.
Yeah, I would say too, just to comment when we talk about regulations or government meddling, it's not just the U.S. government, but it's the Chinese government, right?
Oh, yep.
Almost all of First Solar's competition comes from China. And in fact, I used to own it in the late aughts and early teens and sold out of it when I saw when China made that a strategic priority. What that meant was there were a number of competitors operating at negative variable margins. So not even their full operating margins, but not even the cost of goods sold. They were being told pump it out. And so part of what the government support had been, you might be more skeptical to think that there would be rebates or incentives to buy. There also were tariffs, even long before tariffs were something that claimed all the headlines on solar to counteract those. So there's been give and take all along that distort this whole line.
Yep. Yeah, and the current situation is with the tariffs that are currently under consideration, First Solar has become, at least temporarily / artificially, the low-cost producer in the industry here in the United States. Now that can change in a heartbeat. But you see the cash flow growth checking in at about 20%. That also can be impacted by the stuff we just talked about. But again, I would call it the type of speculation on regulation attitudes and that sort of thing. Could be a worthwhile run if you believe in what they're doing. All right. Anything else on this one, Ken?
No.
Let's go ahead and take a look at company number 3, Payoneer. I have not heard of. The ticker is PAYO. And feel free to chime in, Sandy, if there's anything that you want to bring to the discussion. I mean, I think the notes are pretty good. There's less information. You have a lot less information on this company. The little bit that we do have, including some forward-looking estimates, they're compelling. These are the type of pictures that will even get the attention of a skeptical Ken Kavula. He just wants to see them for a little bit longer most of the time.
Well, I want to see them not so much. I like that they exist out into the future, but I'd like to see a little bit of past to go along with it. And I'm keeping in the back of my mind the fact that that blue graph down there at the bottom, the earnings graph, only basically has 2 points of real data. The other 3 points are forecasts. So we have a 2023 earnings number and a 2024 earnings number, and they make a straight line when you connect them. And you can extend that straight line if you wish, but I'm not sure we have enough information to make that extension with any certainty to it. I also have a real strong bias against a company with a quality that's under 50. And this company has shown 2 quality numbers now, and both of them are under 50. So again, my bias is to say to myself, I can probably find something that is better than this. I don't have to stay in this industry if I don't want to. I don't have to stay in this sector if I don't want to. And I think that's sometimes where people get balled up. They feel if they discard a company in a particular industry, then they should be looking at another company in that same industry. And maybe the simple answer is you just picked a rotten industry, choose another industry. There's hundreds of them, choose another industry.
Yeah, and something I wanted to point out during the introductory sessions we did for the Mid-Michigan series, anytime the financial strength at Value Line is less than B+, double down on that caveat emptor. Okay, if you're a beginning investor and the financial strength is less than B+, that usually means you're looking at a company that's potentially damaged or distressed merchandise, and you want to be careful with that. Or it could be going the other way, but again, be very careful. Here's a look at the proof.
And B+ is average, right, Mark?
Yep, B+ is.
Yeah, there are no D's and E's, okay? B+ is average.
B+,
so.
you should be sending your child to their room. So I know we don't do that anymore, but you know what I mean. The projected return on value, I do think it's good that it lined up. There's no gymnastics required here. Same situation applies here. Not a lot of information. Competition rising, which could put a lot of pressure on this ultimately in this area, but these guys seem to be doing well. At least they do have a PE ratio, is what Matt always tells me. And here's a look at the projected cash flow. There's not enough information to really do anything with. It's going to be important where this one comes in.
And Mark, we've done work in public on the competition in this particular industry. I mean, we have Paychex and Paycom and ADP and a slew of other smaller companies. So the competition is fierce among these companies, and it's kind of like the competition you saw in some other industries where you had to wait 8 or 10 years for it to shake down to 2 or 3 winners for the whole thing. I mean, it used to be that it was ADP for the big companies and Paychex for the small companies, and that's no longer the case. So you might want to tread very lightly and make sure you take a look at all the competitors if you're dealing in this industry.
And, dig in and see, do they have something special, a special hook or feature that we should be, that you should be aware of? Maybe they do. And I would draw everybody's attention to it. I mean, if Matt Spielman were to mail me some of his mad money, I would put in basically an alarm or an alert setting at 5. And yeah, I would, depending on the rest of that story, if it got down below 5, it could be interesting enough to at least scratch one's head over.
Well, and Mark, if they have a feature that's unique, I mean, we had a company come in where they were allowing the employee to deal right directly with the payroll records. And that was a very unique feature for a few months. And then the big guys began to duplicate that feature, because those are the kind of things that you can't put any protection on. You don't, you usually can't copyright them or put a patent on them or anything like that. So whatever what one company has, the big guys are very eager to duplicate it if it becomes something that's desired and takes customers away from them. So you got to be very, very careful. And again, the competition in this industry is fierce right now.
All right, so there you go, Sandy. There's your three companies side by side, along with the three legs of each stool. So this is the way that I think these methods and perspectives really do complement each other, and we will continue to search and learn. All right. Here's a discussion that erupted out of our Heart of Illinois discussion a couple of weeks ago. We got to talking about, well, how many stocks should be in a portfolio. And next thing you know, we're playing around with artificial intelligence, and Bakul is pulling up stuff from Phil Fisher's book, Common Stocks and Uncommon Profits. He was a fan of diversification, but not too much diversification. That's the polite way of saying it. He believed that you should own fewer stocks than most people thought were necessary. And but we had some fun with this, because one of the participants, who shall go nameless, but his name is right here, pointed out that he had many more than 20 stocks, many more than 20 stocks. And he sent us this note. And I just love that an investing legend has called one of us financially incompetent. So Ken, how incompetent are you?
Well, I'm fairly competent, Mark. I kind of, in all the portfolios that I run, first of all, there's a tremendous overlap in the three portfolios. I run an IRA for myself, an IRA for my wife, and a taxable account. And in those three portfolios, which are fairly good size, there's a huge amount of overlap between the stocks that exist in all three of those portfolios. And for each one, I try to keep it to 16 plus or minus 4. And that puts me right into the sweet spot, 12 to 20 stocks in each of those. I'm much more comfortable around 15 to 17 stocks. And I'm noticing that Fisher is mentioning no more than 17. I get a little antsy up around 19, 20. It becomes a lot to manage. I've had portfolios as small as 12 or 13, and I've been very comfortable with those portfolios. They can be painful during market downturns, I will say that. But so can portfolios made up of 150 stocks. You know, that's all that an index portfolio is, made up of 30 Dow stocks, or made up of 500 S&P stocks, or made up of 5,000 Wilshire stocks. So I'm doing my job in that particular area with my adherence to 16 plus or minus 4.
Well, I'm really impressed by that, because, you know, I did a little bit of digging. I found myself to be relatively incompetent. Not counting Buttonwood, because I don't think those really, it's not fair to count those. They're really small. And I own many of those in other portfolios anyhow, but not counting Buttonwood, I have 29. So you may have to jump in your car and go on an intervention run, Ken, one of these days.
I will say, Mark, that
sometimes that's called a financial diversification.
Yeah, I will say, Mark, that I don't include the club holdings. When I talk about if I own a stock at programs like this, if I own it in a club, I'll mention that. But as far as my diversification is concerned, I don't count those club holdings as stocks that I truly have control over, I truly own. So they're outside of my personal holdings. But in my personal holdings, where I have dual control with a very great stock picker that lives with me, 16 plus or minus 4, and our rule probably is 14 plus or minus 4 when we come right down to it.
Well, that's fair. I mean, if I own QQQ, I'm not going to admit to owning 100 stocks. I mean, that would be just one. How about you, Kim and Matt? How incompetent are you?
I have 12.
12 stocks. I figured you're pretty focused. How about you, Matt? Are you willing to admit if you're in the Emmerich camp or?
Yeah, no, I'm at 19. I'm kind of like Ken, and I've probably bought 3 new stocks this year. Of course, this year is full of bargains, right? It's full of volatility, can be full of bargains. You add to ones you may have, and it's easy to find new ones. But above 15 or 16, I start to get antsy. I start to want to put them in the cage match.
All right. So I'm going to self-impose an intervention and sell a few companies when it makes sense to do so.
Yeah,
Well, I think all you have to do, Mark, since you developed this wonderful dashboard, you should just put them all in there and see what you see.
yeah, it's a simple ordering. You know, that's the point too. We talked about advice for beginners. I'd also say there's advice for folks that are listening to us that we spend a significant amount of free time on it, and maybe you're still working, you have kids in school. I'd say don't follow more than you can comfortably or don't invest in more than you can comfortably follow.
Right.
Whether your process is fairly streamlined, you rely on Morningstar and Value Line to really look at the nitty gritty, and you use the tools and use them well, or you do a lot of your own original research. You know, it's perfectly fine to index a portion, even a high portion of your investments, and use some of your money to learn from, and then also exceed the market. But don't get in over your head in things that you can't keep up to date on it for quarterly earnings, that sort of thing.
Good stuff.
I will say, Mark, that I do hold money in indexes quite often, and I hold money in money markets quite often, and I don't count those as holdings.
No, I wouldn't.
That's just a place to park something.
Mm-hmm.
But one of the things that I also stress a lot when we teach up here in mid-Michigan is that if you can interest your partner into becoming even remotely involved in the investing that you do for your family, you have the opportunity then to cut your job significantly as far as time is concerned. And I'm lucky enough to have found a partner that wants to be an equal partner when it comes to investments, and wants to know just as much as I do, and wants to have just as much of an input as I have into what our investments are. And so that cuts my time, you know, by about 40% about what I have to do to maintain a good portfolio.
Yeah, and we should all be blessed with a Natalie and Ethan to help us out. There's no question about it. All right, well, here you go. We do archive all of these sessions under YouTube. The address is up there at the top. You can find both sessions, previous roundtables, and some of our educational sessions there. They go back many years. By the way, this could be the view from my office right now also. That's where I'm at, Ken. That picture is right out the front door. And just a couple more, what are we going to be doing tonight, Ken? Let the audience know.
Well, the Mid-Michigan Roundtable, sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing, is coming up. Our monthly roundtable is this evening. We're starting at 7 p.m. rather than 8 p.m. because we're partnering with the St. Louis chapter. Our special guests will be Candace Baker and Jerry Wright from the St. Louis chapter. We're also going to have Cy Lynch, myself, Mark Robertson, and Hugh McManus there. And we're going to be presenting stocks in the traditional roundtable format, but from 7 to 8, we're going to involve ourselves in a class called Machine Learning, Machine Churning. And we'd like to begin to make the investors that participate in our programs, first of all, aware of the fact that AI chatbots or AI engines, or whatever you'd like to call them, are becoming useful. And they're becoming useful in answering simple questions, and they're becoming useful as you begin to do stock analysis. What we'd like to do is discover which ones seem to be the most useful, what kind of questions can you get reliable data for, and what kind of questions are the chatbots still not very good at. because we think that's equally important to making a decision about what you're going to use. Don't expect us to answer all those questions in a 55-minute class, but we'll try to get started on those topics, and then we'll try to continue this series at different times in the next year and a half, because we're pretty committed to the idea that this technology is not going to go away. It's only going to get more robust, and it's only going to be used by more and more people. Let's not end up with the reputation of anybody over 40 not being able to use a chatbot, okay?
Yeah.
Let's get to a place where everybody can use one of these, because they're really quite simple when you get down to the usage. There's no algorithms you have to learn. There's just, you know, do you ask good questions or don't you? And the better questions you ask, the better the answer you get. But that's true in conversation or in teaching, and it's very true when you're dealing with one of these chat engines.
Yeah. So our mission tonight is basically to whet your appetite and nudge you into exploring and learning.
That's 7 o'clock tonight. And folks, if you don't have a link to get onto that website, drop Mark or me an email, and we'll be very happy to send you a link where you can register for the roundtable tonight.
Okay. Here's a reminder that we're going to be getting together in Rochester, Michigan on April, with the date, or excuse me, May 10th.
How about May 10th?
And there's our two images, the tulips in Chicago, which looks dramatically different than Arizona, and a fairly neat picture from St. Louis. So with that, I guess I'll see you in a few hours, Ken. And I hope many of you will join us. Thank you all for taking the time to join us today. And hopefully we nudged you in some directions which will help with your investing efforts. Thanks, everybody.
Good afternoon, all.
Bye-bye.